Hey everyone, welcome to this week's release of the Hashrate Happy Hour Podcast. On today's show, I'm joined by Dan Roberts, the co-founder and co-CEO of Iris Energy. This is an episode where you're truly going to get a look at an institutional-grade company view on Bitcoin mining as a business. Dan does a great job walking through the risk profile of being a behind-the-meter customer of power, how Iris Energy is looking at new projects, and how they source their renewable power. Also, you're going to want to make sure that you stay tuned to the end for a teaser on what Iris Energy is working on right now. Today's podcast is brought to you by our sponsor, the Texas Blockchain Council, a Bitcoin-first nonprofit industry organization working to make Texas the jurisdiction of choice for Bitcoin mining and blockchain innovation. They will be hosting North America's premier policy conference for Bitcoin and the digital asset ecosystem on November 15th through the 17th in Fort Worth, Texas. For more information, please visit their website at texasblockchaincouncil.org. Hey everybody, welcome back to the show. Like I said in the introduction, I'm here with Dan Roberts, CEO at Iris Energy. Dan, welcome to the show.
Thanks, Ben. Good to be here.
Well, I'm super happy that you were so willing to get up at the ass crack of dawn to have this discussion with me. It's so early for you in Australia, and so I appreciate you taking the time. I'm excited to get into this conversation today and talk all things renewable energy and Bitcoin mining and all the above.
No, not at all. Used to the early starts, particularly combined with 5 young kids.
Yeah, well, that'll do it. As far as an early start, I've got a newborn, so I don't even really get sleep right now. I'm still at that stage.
Yeah, I know the feeling.
Yeah. Well, Dan, I always like to start the conversation with a walk through your background. It helps me and the audience kind of understand where you're coming from as far as like your experience and your expertise. So would you mind walking through your background and then tie that into how that led into Bitcoin mining and Iris Energy?
Yeah, sure thing, Ben. I think my background is very similar to that of the other 100 people working in this business, and it's very traditional. Energy, infrastructure, data centers, construction, funds management. So personally, I started life at PwC with the green pen doing audit, then moved across to Macquarie, the Australian Investment Bank, where I worked across Sydney and London developing renewable energy projects, so wind, solar, across Europe, Australia, etc. And then about 13 years ago, I left Macquarie to join what at the time was essentially a startup infrastructure funds management business called Palisade, based in Sydney, right place, right time. We ended up growing to about $6 billion worth of infrastructure assets. So ports, airports, wind farms, solar farms, gas pipelines, basically taking long-dated pension fund, insurance company money and deploying it directly into these real-world infrastructure and energy assets.
Yeah, so thank you for the walkthrough. I think it helps, again, just kind of highlight the experience in the background. And I think it's very unique for the space, to be honest, as far as like all the energy and infrastructure background. So I actually, and I want to kind of stay on that thread for a little bit here. I'm super curious about those types. So renewable, solar, wind, those are the really big ones. There's not a lot of hydro, but solar and wind projects. And you mentioned, you guys were taking a long dated approach, but how are you guys approaching those before Bitcoin mining? Like what was the approach to those from like a business perspective, and maybe like the return like component to it?
Well, look, I think if you looked at the genesis of this wave of wind and solar projects being built out globally, particularly in Western markets, it's all been supply side government driven. So we've got this decarbonisation agenda. We want to decarbonise, and the pathway we've chosen, rightly or wrongly, is just to push intermittent renewables onto the grid. Now, we've got the intermittent issue. We haven't had the demand. Western economies have seen the decline of industrial loads, commercial loads, even residential loads with the build out of residential rooftop PV through other subsidies. So what we've ended up in these energy markets is almost a race to zero, where you've had all this generation pushed onto the grid. It's forced out the more reliable fossil fuels, and there hasn't really been a solution around the time of day production issue. So when the wind blows, the sun shines, there's an abundance of energy. Prices often go negative. But when there's a network issue, a weather event or similar, then all of a sudden prices spike to really high levels and the network is unable to cope. So on the other side of that equation, we were deploying capital into these projects. So buying the equity in wind projects, solar farms, raising debt, managing them. And they were a tough business. Returns were being compressed because everyone wanted to be green. Everyone wanted to deploy capital into the space. And the risk profile was going up. So for me personally, it was, well, that's a really interesting dynamic where the government is playing an active role in pushing cheap energy onto the grid. How do I get on the other side of this? How do I, instead of being part of building this energy, start utilizing this energy? So in addition to Iris, I've also got an interest in an electric vehicle charging business where we're able to provide the same sort of demand response services by switching off the chargers at a network level to give power back to the grid when the market price spikes and other people by definition need the power.
Oh, that's so fascinating. And it's not something that I have a lot of exposure to, is to hear that kind of explanation of what's going on with these projects. Do you think that more people in that space are going to start waking up to maybe finding like a new demand side component to these types of projects, or are they just going to keep building because the subsidies are there and, like you said, the government's just stepping in a big way?
Well, look, I think if you can generate a return and your job is to deploy capital and generate a return, you're going to keep doing it, right? So to the extent the government subsidies generate that return in the absence of a market mechanism, even if it doesn't make sense at a market level, then people will continue to do it. But I think particularly in Australia and many of the US energy markets, the penny has dropped. We've seen that intermittency really hit home, the grid instability. And a lot of money and energy and time is being channeled into finding grid network solutions, batteries, pump storage, hydro. They've tried to run demand response programs for general manufacturing, retail, etc. But as we all know, have not really received the response anywhere like the ability of the Bitcoin miners to offer that service.
Yeah. And what's been the most interesting is when they try to do it at the residential level. We're like, I'm in Minnesota in the United States and we have XL Energy and they're pretty known and notorious for consumer level, like smart metering and smart thermostat. And it just seems like herding cats instead of, maybe putting large appropriate, demand response program actors on the grid system. It's been an interesting thing to watch. That's for sure.
Sure. Look, at the end of the day, we should be trying everything, and energy efficiency being the operative word, makes complete sense. We should use less energy if we can to produce the same outcome.
Yeah. Yeah. So I, kind of continuing down this track, when you guys were looking at these projects and like you said, you started to kind of see this, like, it was kind of like an aha moment of like, well, maybe we should be looking at how to soak up some of this. So was Bitcoin mining like the perfect tool or mechanism to soak this power up and be kind of this ultimate flexible? Was it like an energy arbitrage play for you guys, or how were you looking at it when you first started?
Yeah, it was multi-dimensional, like everything in Bitcoin. But I think if we look at the key three areas of Bitcoin mining, it involves infrastructure. And clearly, I think people are now starting to understand it's an infrastructure game. It's not a tech play. It involves an understanding of Bitcoin, secondly. So you've got infrastructure, Bitcoin, and ultimately you're mining a commodity. You're generating a commodity with the volatility and the opportunities around that. And so far as those three pillars, if you like to call it, go, my brother Will, co-founder, co-CEO, he was in Macquarie's commodity trading team for many years. So doing structured products, derivatives, loans into traditional mining businesses, gold, copper, iron ore, etc. And for the last year he was there, he was involved in setting up their digital asset team. So we've both got an interest in Bitcoin going back to 2013. And yes, that sounds early and wow, you must have done really well. But no, we bought high and sold low and came crawling back many years later, realizing that it wasn't exactly the magic internet money that we thought it was. And I think there's a few stories that go like that. But our early exposure to Bitcoin, our backgrounds in energy and infrastructure commodities really gave us the opportunity to see what Bitcoin mining was, not only in terms of the underlying profitability and upside for our shareholders in the underlying service, but then the interface with the grids and the ability to provide this valuable community and energy market level service.
That's awesome. Yeah, I right there with you. Not as early as 2013, but bought everything as far as like Bitcoin mining in like 2019, 2020, a little into 21, and then watched it all crash and burn. I just most recently bought a small batch of Bitcoin miners. I bought 10 miners for the same price that I bought one singular miner when I first started. So it's been trial by fire and a very painful initiation into this space.
Not an uncommon story.
Yeah, no, not at all. So I am curious, when you guys started to then make this move into, vertically integrating within the data center and really controlling, because you guys really control the book. Do you guys own the generation assets as well? Do you guys own the wind farm? Do you own the solar field? Could you maybe touch on that?
Sure. The short answer is no, we don't. In the future, that may change. But today, if we go back to the start of the conversation, when you've got all this capital chasing these assets at really low return thresholds, it's a far more optimal use of capital to let them build it and us utilize it. The opportunity for Bitcoin mining to support renewable energy markets is also not at an individual project level, and we can get into discussions around behind the meter and grid connected, etc. But ultimately, the way these energy markets work is they are a melting pot of different generation sources, wind, solar, conventional energy, etc., and different demand sources. And most of the time, they reach equilibrium. The total aggregate amount of generation across different times of day and the amount of load, they net each other out. And we're only talking a smaller number of time periods where they don't, and there is a market issue where Bitcoin miners can respond. There's no point co-locating behind a wind farm that only operates 40% of the year and using 40% power, particularly when that 40% power might actually be produced a lot of the time when the market needs it. It makes a lot more sense to be connected into the broader grid and just supplement and help the broader market in fixing any residual problems that the market can't solve in its aggregate in itself.
Oh, that's interesting, because one of the things I'm just like insatiably curious about is this move of Bitcoin mining up the stream, and like you said, maybe we can get into this now, is like that behind the meter type play, or just going right to owning, the generation asset. I do see your point, though. Maybe, it doesn't make sense to allocate the capital on building a new project, but, what are your thoughts on behind the meter or purchasing a distressed wind farm that maybe ran out of its subsidy and now it's, kind of a underperforming asset?
So I think a lot of it also goes to risk. I mean, like everything in business, it goes to risk return, the cost benefit. And if you compare behind the meter to being broadly grid connected, a key area is risk. If you're behind the meter, all of a sudden you're putting your fortune in other people's hands. And we can get onto this topic more broadly around hosting and other different models. But you're now relying on a single person to provide you with electrons. I mean, that's almost the antithesis of this sector, right? Why wouldn't you rather be grid connected, dealing with a broader utility that you've got access to the whole entire pool of electrons, for example, in the state of Texas, as compared to being behind the meter, dealing with some private sector actor, hoping they honor a contract and hoping you wrote it the right way to get access to the electrons. Like, you feel like you're doubling down on risk. There might be maintenance issues with their transformer. There could be a conflict of interest where they've got maintenance on their wind farm. They need to close down the substation for a period of time. And you're just sitting there saying, okay, well, let me know when you've got power back, please.
That perspective is super powerful, Dan. I mean, and again, I think this comes from just a deep understanding and knowledge and background that you have of that sector, because I just be candid with you. The narrative I hear a lot is, let's get behind the meter. That's the right place to be. It's the cheapest cost of power. And then you're kind of coming in and highlighting the substantial amount of risk that you take with that type of play. That's fat. I'm going to have to get off the show when we're done recording and think about that a little bit more, because it is a little bit, contrarian to what I've been thinking. So I appreciate that. That's great.
Yeah, and look, just have a look at traditional industries that are more established. How many traditional data centers, how many traditional manufacturing businesses do you see go and ask to co-locate behind the meter? I think it's just part of the evolution and the institutionalization of the sector. And I understand where we've come from as an industry. Go back 10, 12 years, it was hobbyists and enthusiasts mining Bitcoin in their parents' basements, right? Like, there's been a trajectory, there's been an evolution. So it's all just part of that journey.
Yeah. I completely agree. And then I think I'm curious on your take on this too, because I think as I'm thinking about this now in real time, you're also kind of helping spread the risk out on the grid too, because again, you're tapping into that greater pool of electrons. You're able to come in and help the broader grid versus just that one pocket or that one generator. I mean, is that another way to think about this too? Is that it actually opens Bitcoin mining up to be a better tool for the grid?
Absolutely. It goes back to what we were saying earlier. Like, the grid is a melting pot of different generation, different times of day, different load profiles on the load side as well. And it's about identifying when the market can't balance. There's no point helping out an individual asset at a discrete level. That doesn't help anyone other than maybe yourself, maybe that wind farm owner. But by definition, if the wind farm's only producing 40% of the year, which is a common load factor, there's an amount of power you need to either not get and not operate or pay the grid for anyway. So it makes a lot more sense to locate grid connected when the market doesn't balance itself. That's when you can play an active role. And ultimately, that's when it's most profitable for you as well.
Yeah. I mean, again, I really appreciate that perspective. That's phenomenal. I think to kind of maybe go another step in that direction, then, I do, again, another mainstream narrative that you hear, and this is kind of coming from like the Bitcoin Twitter ecosystem, and it's kind of this hyperbolic little chamber that I think me and quite a few people live in. You hear that Bitcoin mining is helping fix excess power problems, but is that, and I hear all the good reasons why it is, and you've already kind of highlighted some of the ways that it does. Are there, just to stay a little bit contrarian to that, are there ways that maybe it's not, or to play devil's advocate, like, are you seeing other ways that maybe it's not?
Not really. Ultimately, it could. So if Bitcoin rallies and the profitability of Bitcoin mining goes up 10x, for example, then it's going to be profitable to mine using a very wide range of power prices. And at that point, that's less power that you would be giving back to the market. And maybe to use some numbers to explain exactly what we're talking about here. So at our project in Texas, a place called Childress, we've got 600 megawatts of power. It's up in the Panhandle region where there is just gigawatts and gigawatts of constrained wind and solar. The transmission line capacity just cannot physically move all those electrons down to the load centers in the southeast, Dallas and Houston. So there's a lot of excess renewables up there. So we sign, call it a rolling PPA, power purchase agreement. Let's call it 4 cents a kilowatt hour, so $40 a megawatt hour.
Yep.
Now, I'm going to use broad numbers, so don't quote me on it, but let's say Bitcoin mining profitability this month is around 10 cents per kilowatt hour or $100 a megawatt hour. So you're mining at $40 a megawatt hour and you're generating an equivalent revenue line at $100 a megawatt hour. And that 60% gross profit margin actually broadly coincides with our profitability last month, as you can see in our monthly report. Now, we can trade that power. And what that means is every time the market price of power is above $100 a megawatt hour, it's no longer as profitable for us to direct those electrons into the Bitcoin network as it is to give the power back to the market. So all of a sudden, we've got this optionality and this option play. So every hour of every day, we've actually got an automated algorithm, another benefit of owning and controlling the whole stack, all the way from the grid connection, the land, the infrastructure, the technology. So automatically via this algorithm, it will look at the energy market, it will look at Bitcoin mining profitability, and it will trade between the two. So this not only gives us a call option on power prices, a call option on Bitcoin mining, but that is how it stabilizes the grid. Because when power prices go negative, which does happen, we actually have two profit centers. One, we're paid to accept power. Two, when they're paid by the Bitcoin network to convert that power into Bitcoin mining. Now, when power prices go above the revenue line we could otherwise generate from Bitcoin mining, it makes more sense financially for us to sell that power back to the market, where by definition, other people will value that power more than we will.
I appreciate the just a walkthrough on that. And Texas is so interesting to me. I have a lot that I need to actually learn about that power market itself. I actively trying to find, people within the Texas ecosystem, ERCOT, et cetera, to interview and try and ask a bunch of elementary questions nonetheless. But the energy arbitrage play, and you're actually we're going to fast forward into some of the things I wanted to talk to you about, because we're already at them, is, I think what is really exciting for me when I look at like your strategy and what Iris is doing is you guys really looked like to where the puck was going to go. I'm Minnesotan. I use hockey analogies all the time. So you guys looked to where the puck was going to go and said, all right, we need to be there to profit, centers. And really it's that energy arbitrage plus, the profitability from Bitcoin mining. How long do you think it's going to take before the rest of the market catches up to what you guys are doing? Do you think it's just a matter of time before everyone catches on to you really need to have two profit centers?
Oh, look, I don't think there's a big difference. I think the key thing that is happening and has happened over the last few years is all of a sudden Bitcoin has come into the social dialogue as a permanent asset. So you might recall a few years ago, every cycle that Bitcoin would go down, it's like, oh, Bitcoin's dead again. Bitcoin's going to zero. I don't think I've heard that phrase in 2-3 years now. Like, it's just accepted that you can't stop this thing. And when you've got an ultimately absolutely scarce asset with only 21 million of them in a digital world, I think you can see why we're all here and why we think there might be a lot more upside. I think gold parity, so for Bitcoin to hit gold's market capitalization as gold 2.0, that's $600,000 a coin. We're at 30,000. So it's still super, super early. And I think once you accept that Bitcoin's here to stay, then you accept that all the infrastructure around it needs to stay as well. So all of a sudden, the days of using sea cans and shipping containers, old abandoned warehouses to rig up a few computers and mine whatever Bitcoin you can at the expense of tomorrow, you can see how that starts getting replaced by more long-dated business models that are building out permanent infrastructure, multi-decade infrastructure to secure not just this network, but the broader high-performance computing thematic that we've started to see re-emerge over the last 6 to 9 months as well.
Yeah, HPC is definitely coming into the scene in a big way too. You touched on it, just maybe establishing the infrastructure on a more permanent basis, and then tying in like your guys' site in the Panhandle of Texas, like you said, gigawatts of just stranded or constrained electricity just due to the inability to ship those electrons down to the DFW area. I am curious, I mean, what starts to happen if there is a way to either get the electrons there? I guess the bigger question is like, is that just a permanent state for the Panhandle? Is they just way overbuilt and oops, sorry guys, we don't have a way to ship those electrons anywhere else, so we'll let these guys, Iris, come in and utilize it? Or is there a future where that eventually gets built out, or how does that look?
Look, absolutely, you could build and spend billions, if not tens of billions of dollars on more transmission line infrastructure to move more of that power down to the southeast. That's always a possibility. But again, you're only likely to do that if you can see a business case for producing a lot of power. And the reality is all that power that's produced up there is intermittent. So to optimize use of that transmission line, by definition, let's say it's 10 gigawatts of power, you need to build far in excess of 10 gigawatts of wind and solar to actually utilize that pipe at an efficient level, because it produces energy at different times of day. So almost by definition, there's always going to be a bunch of excess power that doesn't make sense to fit in the pipe because it's at capacity when it goes down. So if you think about the very simple wind farm analogy again, or example, I should say, where it only produces 40% of the time, what about the other 60% of the time? By definition, you've got to overbuild the underlying generation to actually make use of the transmission line infrastructure. Secondly, you've then got to have some level of political will and social will to spend those billions, if not tens of billions of dollars. And the reality is we're dealing with an extremely profitable area in terms of the underlying wind and solar economics up in that region. And I should finally add, when you're dealing with federal subsidies, tax credits or whatnot, they don't differentiate typically between where these projects are located. So you can get the same production tax credit for being located in the middle of nowhere where no one's going to use the energy as you would being located in downtown Dallas. So you can see how that gives rise to, I wouldn't say necessarily a misallocation of capital, but it does distort the price signal a little bit.
Yeah. Do you think that'll clean up over time? Like, do you think that I mean, I'll say it. I think it is a misallocation of capital, but do you think that kind of cleans up over time as people start to key into, maybe how to build renewable generation assets, either in better, I'm not even sure, but do you think that'll get better over time? Like you'll see less of stranded gigawatts of power over time?
Look, commercially, I think it's almost self-explanatory. It should get better, and then it's just a case of politically what's the likelihood we see a commercially sensible decision and all the other less commercial drivers that happen at that level.
Sure. Yeah, it's interesting. So it kind of leads me into, like, I'd love to hear your strategy when you're looking for new sites. Are you guys looking for exactly that Texas Panhandle type scenario where there's just an excess of stranded energy capacity, or can you maybe talk through like the strategy for looking for new sites?
Absolutely. And in some ways, it's the flip side of that renewables development coin. So a number of our team have spent a lot of the last 15, 20 years around the world developing wind and solar projects in different geographies. Instead of chasing the best sites with the most wind, the most solar, the best grid connections for generating that renewable energy, we're now looking for the best sites to take advantage and monetize that excess renewable energy. So it's a very similar process in the sense that we'll start with a map of the world and we'll identify geographies and markets where we would be open to operating business. So that's the first filter. And given we set out as an institutional grade business, we're very much focused on Western geographies, rule of law, stability, etc. Markets we know that institutional capital will be comfortable in financing at a reasonable rate of return. So that leads us to North America, countries in the Asia Pacific region, etc. So the next step is to say, well, 100% renewable energy. We've been 100% renewables since day one. We make sure that we are 100%. And I think there's a bit of a jingle in the sector to say that we're using renewable energy, but I'm not sure there's actually been an audit or any reporting requirements on the actual validation of using 100% renewable energy. And we can get into that a little bit more later if you'd like. But what it involves is looking at energy markets where there's an oversupply, excess amount of renewables generation for whatever reason. That's happened in British Columbia where we've got 3 projects, but for a very different reason than it's happened in Texas where we've got our 600 megawatt project. It's then a case of identifying parts on the specific energy network where we believe and understand from our research and conversations with market participants that there might be excess power. We've then got a door knock on local farmers and say, we need some land. Would you be willing to let us option up a parcel of your land? That takes process. That takes 6 months, 12 months, 18 months. It can take a long time. And only at that point have you got the ability to then go to the grid connection company and say, hey, we've got a land. We think there might be some power. Could we please commission a connection study? That process then can take another 6 to 12 months where you pay them a relatively small amount of money, but they'll then go through and map out the network and work out technically how much power they could actually supply you and under what conditions, e.g. what connection infrastructure would they need to build, how much would it cost, what would you be liable for, et cetera, et cetera. So as you can see, you can extrapolate those timeframes. You're already 12 months to 3 years into a process of finding one of these sites before you even get an investment decision to build out connection infrastructure.
Oh, yeah.
That connection infrastructure then takes another 12 to 24 months. Like in some of these markets, it can be 5 years from the point at which you actually identify it's a market you want to be in through to the point at which you've actually got electrons available through the grid connection. So one of the things we've spent over the last 5 years is running around the world, optioning up all this land, all these sites, and progress that development activities. So yes, we've told everyone that we've got 3 specific projects in British Columbia that are operating. We've got the site in Texas that is operating, but we do refer to this global portfolio of projects in excess of 1 gigawatt of energy under development, and over 1 gigawatt could mean any number over 1 gigawatt. But it's fair to say that we are just progressing all those sites in the background, incubating what we believe to be incredibly valuable optionality.
I appreciate the detail there, Dan. That's a fantastic look into like your process. And I think also, and I have, some discussions with groups that are building much smaller projects, and I mean, even a 10 megawatt site, that's a pretty big site, but in comparison to a 600 megawatt site in the Panhandle, that sort of thing, they're smaller sites. And the one thing I hear the most is, well, I want to have everything up and running in 2 months, 3 months, like everything. I want the interconnect done. I want power flowing. I want, a couple CCANs on the dirt with miners in them in 2-3 months. So the look into your timeline is fantastic.
Yeah, look, it's really hard to shortcut those development timeframes, and you can look to do it. You can look to do it by going behind the meter, as we discussed, using old warehouses, trying to utilize a hosting model where someone else might have got a jump start on those activities. But there are costs and drawbacks and compromises that you need to make if you do that.
And I'd be curious, actually, you mentioned it earlier in the conversation too. From your perspective, what are some of the risks with like a hosting model? Because again, it's that speed to market thing, but you're giving up so much. When you map out like the risk profile on co-locating or hosting, what do you see there?
Well, let's start with speed to market. Is it? We've got some pretty high profile Bitcoin miners that use that model. Have they outperformed deployment timetables?
Not really.
So maybe that's an interesting no, because ultimately, is it easier to just do it yourself rather than rely on a handful of other parties that may not have the same alignment to do it on your behalf? I think I would rather have the control, because at the end of the day, you can't change reality. You can't change the law of physics. if you need power, you need to go through a process to get that power. Whether you do it directly or don't have the capability and need others to do it, someone needs to do it, and there is a time frame involved. So I would argue that hosting and speed to market, and you've alluded to the evidence, may not be all that it might be cracked out to be. But then you've got the bigger issues around you're now letting other people looking after your computers. What's their incentive? What's their alignment? And some of these contracts are public. They're publicly published in terms of security and access to those electrons. And all of a sudden, those demand response services that we spoke about that are highly profitable, we generated $600,000 a month, last month alone, in selling power revenues. Yeah. Now, if you're just using hosting services, then all of a sudden the hosting provider, depending on the market, the contract structure, gets to monetize that upside and just switch your computers off. And again, you can contrast this in the data. The evidence is the uptime. So how many Bitcoin do you mine each month per unit of computing power? And we can see those level of uptimes, particularly in the public miners, and see what loss and slippage emerges through the different business models. But fundamentally, if we step back even further, we understand the optionality in Bitcoin mining. We understand when the cycle turns, you are making extraordinary amounts of money because the real world can't keep pace with the digital world, i.e. you're dealing with this parabolic exponential asset that can go up 5, 10, 20x times. Yeah. You can't 5x the amount of infrastructure and mining capacity to normalize profit. So you get these periods of exceptional super profitability. Now, if you're sitting there as an owner of hosting facilities, earning 1 cent a kilowatt hour as a margin, and all of a sudden the dude that's using your infrastructure that you've spent years building is earning 50 cents a kilowatt hour, what do you think's running through their head? What do you think's happening with contracts, contract renewals? Are they really motivated to honor those contracts, etc.? So it's a risk profile, and it drives this misalignment where I just think it's unnecessary, particularly in a sector that is emerging, is young. You're not dealing with institutional grade counterparties, AAA contracts, etc. I think the safer approach is to own and control everything and make sure that you're managing risk, because that ultimately allows you to monetize as much of the upside as possible at that point in time.
I couldn't agree with that anymore. My own journey into the Bitcoin mining industry, has started with a series of just kind of testing to see what hypothesis, has some legs. And one of the ones I'm actually in the middle of right now is, does a hosting model make sense? And I, for the life of me, and for a long time, tried really hard to find the alignment of incentives, and I just couldn't. For so many reasons, there is so much dislocation in the incentives between a host and the hostee. It's been an interesting learning for me, that's for sure. You mentioned that there are these periods of super profitability. Could you maybe touch on that a little bit more? Because I think that that's a super interesting concept, and I'd love to hear you expand on that a little bit more.
Yeah, sure thing. And this goes to the asymmetric business model of Bitcoin mining, because you get this asymmetric upside, and then you also get this downside protection. So Bitcoin mining, we understand that if you've got a share of the network, you essentially get a share of those Bitcoin rewards every 10 minutes. So if you've got 2% of the global market, you get 2% of the Bitcoin. It's just the way the maths work out. Highly predictable. Every day we get it, right? So the price of Bitcoin goes up. You get more Bitcoin. There's an economic incentive for you to reinvest in more capacity, as well as others to build new capacity to try and get more of that Bitcoin because it's more valuable. So if we go back to the start of the last bull run, when Bitcoin was, what was it, $6,000, $8,000, $10,000 a coin, there was anecdotally around 8 gigawatts of power, 8,000 megawatts of power globally dedicated to securing the Bitcoin network. All of a sudden, Bitcoin goes on another 5x run, up to $50,000, $60,000 a coin. To normalize profitability, and maybe stepping back, that means that you're now receiving a revenue line that is 5 times higher every 10 minutes. If you received 1 Bitcoin every 10 minutes worth 8,000, now you're getting 40,000 without having to change anything in your underlying business, right? Like it's extraordinary. Same power cost, same corporate overhead, same everything, except your revenue line is just exploding. Now, what then that means in terms of trying to normalize that, say, well, markets are efficient, why don't they do it? Well, because the laws of physics get in the way. You're dealing with a digital exponential asset that is unconstrained by the real world. It can do anything. But to bring online more mining capacity, all of a sudden you need to find 30 gigawatts of power. The entire global data center industry is around 23 gigawatts. Just click your fingers. You can't do it. You need tens of billions of dollars of capital. You need years and years and years of manufacturing, of hardware, energy infrastructure, etc. So that is the dislocation. That is the inflection point that as an industry we've now hit. And that is why you generate these super profits. And it also touches on why is the hash rate continuing to go up as the Bitcoin prices come down? Because the hash rate is still catching up to where it needed to be. Right. So, but over the last 12 months, like, guys, you can't look over the last 12 months. You've got to go back to when the hash rate and price was last normalized. And where it normalizes actually changes each cycle. So during the last cycle, so last year, we saw mining profitability normalize at around that 7-8 cents a kilowatt hour as a revenue line. And that is just extrapolating the revenue per kilowatt hour of latest generation hardware. Okay. Because every time the profitability went below that, you saw the hash rate go down, i.e. people are switching off because their power cost is too high. Anecdotally, you'd know that 7 to 8 cents per kilowatt hour lines up with a lot of hosting rates in the sector over the last few years.
That's right.
Go back 6-7 years to the last cycle, and the break even was around 5.5 cents a kilowatt hour, which at the time lined up with a lot of the hosting rates at that point in time. And it stands to make sense that over time, the low-hanging fruit gets gobbled up early and the whole cost curve of the mining sector goes up as more people come in chasing more and more power. So that's the upside opportunity. And then I can touch on the downside in a minute if you like.
Oh, yeah. I mean, how long, and maybe it's the secret sauce and you can't, but like how long until we normalize again, and where do you think the next cycle runs? And I know that second half of that question is all hypothetical, but how long until we normalize, and what does the next cycle look like then? So
I think if you go back to that 7-8 cents a kilowatt hour that we saw late last year when Bitcoin, touched the teens, and we saw the hash rate go down, and you can go and look at the data. Best thing about this is you don't need to trust me. You've got a mutable permanent ledger. You can go and back test and validate yourself. If we're now at 10, 11 cents a kilowatt hour, then it's just simple maths. If people can get power at a price less than 10, 11 cents a kilowatt hour and have a spread that's sufficient to pay off the capital investment they make and generate a return, then they will. So I'm not here to hypothesize on what rate of return people need and what power price they can all get to do that. But you can see the spread when we're investing in these projects like Childress, where we can drive our power price as low as 1, 2, 3 cents a kilowatt hour using our algorithm. And that's just simply playing off the market and saying, well, what cost of power do we want? Because we can just sell more power back into the market, generate less Bitcoin at a lower cost of production.
That's fantastic. So you mentioned downsides in there too. So what does that all look like?
So in addition to the downside protection I just outlined, where we control our power cost in Texas, because we can just mine less Bitcoin and give that power back to the market, to the extreme bookend of operating with two profit centers, only operating when power prices are negative and we're paid to take the power, and then we get paid to turn that power into Bitcoin. So it's a whole spectrum there, but that flexibility and that investment we've made up front gives us enormous downside protection and robustness through the cycle. But the other one, more at a macro level, happens for everyone who's got low-cost power. So when the price of Bitcoin goes down, it gets to a point where people can't afford their power price and start turning off, as we saw late last year, as we've seen in the depths of other Bitcoin cycles. What then happens is the global hash rate shrinks. You as a low-cost miner, your share of the network goes up because you're still generating the same amount of hash power, using the same amount of power, but that hash rate is now a greater proportion of the network, and you're receiving more of the Bitcoin reward every 10 minutes. To use a really simple example, if the overall network halves and you were 2% of that network, then now you're 4%. So you're getting 4% more Bitcoin. So you end up mining more Bitcoin each day, but your power cost is unchanged. So unlike any other commodity mining industry on this planet, you've got this unique downside protection where as the price goes down, you get more of the commodity. You've got a volume hedge. So your unit cost of production goes down as the price of Bitcoin goes down. So people say to us, well, last month you mined Bitcoin at a price of $13,000 a coin. Does that mean if Bitcoin went to $13,000 a coin, you'd have to switch off and you'd be unprofitable? No, not at all. I've just spoken about all the flexibility we've got to adjust that 13,000 just through our power trading.
Yep.
But B, think about all the high-cost miners that have switched off before we even get close to 13,000, driving that 13,000 lower and lower each time.
Yeah, you'd have a real China ban scenario on the hash rate if Bitcoin price just dropped like a rock, to 13 or lower than 13,000 a Bitcoin. Yeah. So Dan, just to be cognizant of the time, what I wanted to maybe wrap the conversation up with asking you is, and maybe you can, maybe you can't, but I'd love to hear like what are maybe a teaser on what Iris is working on now. Are there any big cool projects that you can maybe tease or share or shed a little light on that you guys are working on at Iris?
Sure. So we've got $64 million cash in the bank. I think we generated $6 million US in mining profit. That's gross profit last month alone. We're in a good spot. We've got 580 megawatts of immediately available power at Childress. We're only using 20. So we're very focused on growth and expansion there, taking our 5.6 exahash up to 13.6 exahash as and when we can build the required data centers and buy the chips. In parallel, we're looking at those additional development sites globally, and that's a good segue into the final area of growth for the business, which we're quite excited about, which is the high-performance compute. So this is all the AI, machine learning, all this energy-intense computing applications. And we told the market, 3.5 years ago, we signed an MOU with Dell Computing to actually start doing this out at our first site in Canal Flats in British Columbia. But the market wasn't quite there. The opportunity in Bitcoin mining was. So we put it on ice, put it on hold. But over the last few months, we've dusted off that work, re-engaged with the sector, and it looks like a really interesting proposition. We've seen some others go into it. Again, we think our data centers, and again, I think we're one of the few Bitcoin miners that actually build proper multi-decade data centers. We think that they can be utilized for this. So we're pretty excited about that. Equally, we're not going to jump in head first. We're going to make sure that it's a sensible decision and pursue it incrementally.
I appreciate the little teaser there, Dan. You guys are working on some awesome stuff. It's been awesome to watch you grow. It's exciting to hear what you have in the pipeline coming up as well. I want to make sure I give you some room here at the end for a handoff so that the audience can find you, your team, what Iris is working on. Please give the audience how they can get in touch with you and the company.
Sure. We've got a website. We've got an email distribution list for our monthly reports. We're listed. There's a lot of publicly available information. We're on LinkedIn and we're on Twitter. So Twitter handle for Iris Energy Co, Iris Energy Co. And I'm also on Twitter, Dan Roberts 0101.
Awesome. Dan, this has been a fantastic conversation. I really, again, you're up super early to take some time for me. So I greatly, greatly appreciate it. And you take care.
Anytime. Thanks, Ben.